and when you use it, it reduces assets. We lose
Florian, I think you need to watch our lectures 2 weeks ago lecture in which we talk about the nature of the accounts. Okay, the prepaid is our asset. The nature of the account is our assets because it's our claim. Because we pay in advance, so it's our claim that we will receive the service later. But this is unearned. This is our customer paid us in advance, not we paid our customer. Our customer paid us in advance, right? So it means we are liable to deliver later. So we create liability. So this is, the nature is not asset, the nature is liability. So that's why we created unearned revenue as liability, credited it, right? So there are 4 types of adjusting the account. In our last lecture, we discussed that. We also revised there. One is prepaid, the nature is assets. One is accrued expenses. So we talked about, okay, accrued expenses. Number 1 is the unearned sales or unearned revenue. So the nature is of unearned revenue is liability, not the asset. And the 4th one is accrued revenue, which means we deliver the goods, but we are not being paid. In that case, we still need to receive the money. That is our part is fulfilled. So it means that is our asset. We need to recover that. What we have to pay is our liability. What we need to recover, that one is our asset. So that is the nature. Please go back over there, watch on the YouTube. You will be very clear that what we are talking about. So there is a nature of the accounts in which we talk about these assets. These accounts belongs to assets. These account belongs to liabilities, and this account belongs to owner's equity. Okay, Coco, understand?
I think I need to do like Florian, like go back and review the meaning of some words.
Okay, Kathleen, you understand this?
Yes, I understand it now. I didn't before, but now I do.
Okay, Ali, Nimesh.
Yep, makes sense.
Nimesh. Okay. Dijodi.
Yes, sir.
Fabian. Wu Xiong.
Yes, yes.
Good. Anis.
Yes.
Okay. Lota.
Yes, sir.
Okay. Let's move forward. And now the last one. So I hope this one okay, let's do it together. I'm not creating a breakout room. Here we go. So this is in continuation of our previous adjusting entries. So here we go. Still, the year ends on December 31st, 2014. So interest revenue of $900 has been earned but not received. How you make this entry? Interest revenue earned. So it means in 2014 December, this revenue belongs to 2014 December 31st. We delivered the goods, or we performed the services, or the rent is earned. It means sale happened. But do we receive the cash?
No, so you do a receivable.
Yeah, well done, Fabian, well done. So what would be the entry? So receivable, our assets. So receivable, increase mean debit. And revenue, increase mean credit. So entry would be receivable to sales. Since we are dealing in interest, so entry would be interest receivable to interest revenue. Understand?
Yeah, I have a question.
Sure.
You know when you say, can you go back just one slide before? Yeah. When you say interest revenue, So I know cash should be increased. But also, when you say just interest in revenue, it should go to owner equity.
Remember, wait. So how we know that this is the business of interest? Previously, we talked about this is renting revenue, renting business, right? Florian, I think
Yes.
you are confused with the nature of the business, rather, nature of the accounts. So in this entry, how we know that we are in renting business? And in this entry, how we know that we are in money business? Like this is the entry of like bank, right? So when you basically when you read the transaction, so you realize that we are talking about renting business. So here on July 1st, 2014, when business collected 1,500 rent in advance, so it debited the cash and credited unearned rent revenue. So focus on, so this is one word, unearned rent revenue, and you pick that one because we are talking about which kind
Renting.
of rent revenue, which means our business is renting houses or renting the places. Plus, the tenant was paying rent for 1 year. So the next line also supports our argument that, okay, the tenants are our customers and we provide renting services. Now, next slide is, we're talking about interest revenue. So these two are not separate. These are one word, the interest revenue. It means this is our sales and we are providing our services of renting money this time. Okay. So this our sales is now receiving the interest. We provide loans and our sale is that we receive interest. Understand?
Understand.
Okay, so when you read the sentence, please read very carefully. So most of the time, 90% of information is on sentence that, okay, you can just grasp, okay, this belongs to which business, okay, now this account belongs to which one. It just automatically at the fingertips, it's gonna come into your mind, okay, okay, we are in this business and okay, the nature of the business is like that. So its assets gonna be like this, its liabilities are going to be like this. So you can just create entry in a matter of seconds, just buzz. But you need to be very sure about the rules of debit and credit. Otherwise, it's going to be very hard for you to make an entry, post into the T accounts and then income statement, the next of the stuff, like it's going to be very hard for you to reach on to the balance sheet. Okay, everyone? Okay, Dijodi, Ploy, Wuseong, Anis, Kathleen, Lota, understand?
Understand.
Yes.
Understand, sir.
Understood.
Okay, if you understand that one, then we have the depreciation problem here as well. So now let's talk about this. Equipment was purchased at the beginning of the year at a cost of 50,000. The equipment useful life is 5 years. There is no residual value. It means after 5 years, the value is 0. The value of that equipment is 0. You can just trash it, throw it, that's it. So you need to record the depreciation. First of all, what is the value of the depreciation you use for 1 year? What is the definition of the depreciation? So you spread the cost on useful years. So 50,000, because there is no recoverable value, residual value, or scrap value, just 0 divided by number of useful years. It means 10,000 worth of this equipment we have used in 1 year. So when we have used 10,000 for 1 year, so that becomes our
Depreciation per year, 10,000. The
right?
rate of depreciation, right?
Well done. So this is our depreciation for 1 year. So depreciation is our expense. Expense increase, debit. So depreciation expense to, for this specific depreciation, we create a contra account that is accumulated depreciation, which is the opposite of, so this is just a specific exception for this. For fixed assets, how we record it, we create accumulated depreciation, which is contra account. It means if the value of accumulated depreciation rises, it's opposite to the asset. Asset rises, debit. Accumulated depreciation rises, credit, because this is the opposite of this one. So entry would be depreciation expense to accumulated depreciation. So if you don't understand this one at this time, we already talked about it in our previous lecture as well, but we will be doing this one. We have a whole complete chapter on this one. So if you try to grasp as much as you can, try to digest this concept. If you cannot, please wait till we start that chapter. It is when we talk about how to account for fixed assets. But if you understand right now over there, it's going to be very easy for you. So I'm just going to be not paying too much attention here. I already explained the concept, and just let's move. So how we are going to present it on balance sheet. So we talked about that the accumulated depreciation is our contra account, so here, opposite of equipment. So how we write it down on balance sheet? So equipment account is 50,000. Accumulated depreciation is our balance sheet item, so we write it down on balance sheet. So the book value is going to be 40,000, right? So a logical question that should be asked is, why there's a need of this accumulated depreciation? Why don't we just say depreciation expense to equipment? Why we create, why don't we do that? Decrease in asset, 10,000, and value of the equipment going to be 40,000. So why we are creating this accumulated depreciation? The answer is that in real life, we don't have just one fixed asset. We have a number of fixed assets: furniture, ACs, and not just one ACs. In big companies, we have thousands ACs, 100 ACs, right? Furniture, how many chairs, how many tables? We have thousands of, this kind of stuff. Plants, machinery, buildings, 1 building, 2 buildings, 3 buildings. So when we consolidate, when we sum all those stuff, for a manager or for higher, management, they wanted to know that, okay, what is its true value when we purchase that one, and how much we have used. The accumulated depreciation is increasing year on year basis. So it helps them to, give the idea, okay, so this time, this is the time to replace the asset. Okay, next year the asset is going to be expired. So what we're going to do? Okay, and then there are different financial decisions. Okay, how much time left for this plant? Okay, how much is the cost of this plant we purchased, and how much we consume that one? What would be our next